What's going on, you guys? It's Marcos, and in this video I'm going to be showing you exactly how mortgage companies can actually rip you off. So next time that you're shopping around for a mortgage loan, whether you're buying a house or you're refinancing an existing one, you don't get screwed over. Okay, you see, most people actually have absolutely no idea how to shop around for a mortgage loan, or at least they don't know if they are actually getting a good deal or not. And see, what happens is, and the biggest problem that I see with people is that they just pick up the phone or they go online and then they're just asking for who has the lowest interest rate, as if the interest rate is the only thing that matters when it comes to getting a mortgage. Guys, when you're getting a mortgage loan, you have to look at the entire picture. And that means interest rate, that means fees, that means what lender you're doing business with, okay? But actually, in this video, what I'm gonna do is I'm gonna show you where to find the lender fees so that you know and you actually know how to compare, two different lenders or three different lenders. Anyways, before I actually do that, this is basically how I would approach shopping around for a mortgage loan. And by the way, this is from the words of a loan officer that's been in the business for almost 10 years. What you want to do, guys, is you want to think about getting quotes from three different lenders, okay? And just narrow down three lenders. You could go with more. Doesn't really make too much sense to go with like 5, 7, 10. You're basically just going to keep hearing the same things. But here's basically what you want to do. You want to submit three different mortgage applications. And when I'm saying mortgage applications, I actually mean the whole thing, okay? Give those lenders a chance to really compete for your business by letting them have a complete look at exactly what it is that they're shooting for. Because you see, you might think that you have a 780 FICO, but you might actually just have a 690. What lenders see might be a little bit different than what you're seeing. So when you give three different lenders the opportunity to actually get your business by you being completely transparent up front, they're going to put their best foot forward. Because right at the beginning, and you can definitely just say this, hey, I'm shopping around for the best deal. Now, that best deal right now just means the numbers. But here's everything. Run my credit, have at it, and here are some of the documents that you're going to need to get me a really good quote. Now, basically what you are going to get from each lender is what they call a loan estimate, and it looks just like this one. Now, this used to be called the good faith estimate like 5 years ago, and for some of you guys that probably own a home back then this is basically the new one, all right? And this has been the new one since like 2017. But anyways, that is the document that you're looking for, and now I'm going to show you where in this document you're going to find what the lenders are charging you and what are some of the fees that are okay to charge and what are some really crappy fees that you should really absolutely never pay for. All right, let's check it out right now. Okay, guys, so basically this is what a loan estimate looks like. And the first thing that you're going to see is that it says right at the top left corner, loan estimate. All right, now lenders are going to give you this document within 3 business days after you actually apply for the loan. Normally would be if they actually pull your credit, they will give you this loan estimate. Now they have to do that within 3 business days by law, so expect to get something like this. Now, what you want to do is you're going to look at 2 different things. You're going to look at the interest rate, okay? The interest rate, obviously, it's important, but don't put your entire focus on the interest rate, okay? Because I'm going to show you how mortgage lenders actually can BS you completely on this interest rate. What we want to do is, as savvy shoppers, I should say, you're going to scroll all the way down to page 2 of the loan estimate. And the thing that you want to be looking out for is the first thing, origination fees. And it's that bucket right there. So this is the origination charges, which is the line A, is literally what the lender can charge you. All right. These are the lender fees. This is everything that has to do with your loan. All right. And there are going to be some different charges that you need to be on the lookout for, because I'm going to give you the good ones. And then I'm going to tell you what are some of the ones that you should absolutely never pay for. Okay. So in this example of a loan estimate, you were seeing 3 different charges. You have 0.25% of loan amount, parentheses points. I'm going to explain to you last what that is if you don't know what discount points are. But you see an application fee, and then you see an underwriting fee, okay? Now, before we jump into what these things are, here's basically a rule of thumb that I'm going to give you. by the way, mortgage loans, mortgage lenders have to be transparent with you. By law, we all got blamed for what happened in 2008. So we're probably like the most transparent industry out of all the financial services. Okay, so we have to tell you exactly everything up front. We cannot mislead you in any ways. That's why you gotta send something like this to you right at the beginning. But a range on how much lenders should charge you would be somewhere between $750 and about 1% of your loan amount. Okay. And in that sort of my range, some lenders might charge you a little bit less, some lenders might charge you a little bit more, but just so as long as you're staying kind of within that range about how much lenders can charge you to do your loan, that's sort of where you want to be at. Okay. And basically origination fees stand for how much the lender is charging you to do your loan. All right. Now lenders can, basically dress up this thing any way possible. All right. So for instance, this one is called, okay, well, we're going to do your loan and you have to pay this underwriting fee. So underwriting fees are normally fees that the lender will say, we have underwriters, they have to underwrite your loan, and this is what we charge so that we can pay the underwriters. The underwriting fees are okay, all right? That's normal. You might also find a combination between underwriting fees and what they call processing fees, all right? And that could be, maybe between both of these fees, that could be a total of $1,000. That's very, very typical. You might see $1,200, you might see $1,500. Between underwriting and processing fees. That's fine, all right? You're still sort of within that 1% of your loan amount, all right? Now, when it starts to get a little bit crazy is when they'll charge you something like underwriting fees, and then that's $1,000 or $1,100 basically, and then maybe origination at 1%. Okay, like 1% right there. And if you're basically in this example, the loan amount is $162, and then on top of it, that would be $1,600. Okay, $1,620. So now you're adding origination at 1% plus the underwriting fee. That's another $1,097. And then in this example, that's another $300 for the application fee. So now it starts to get a little bit more than what I would say is fair. That's about $2,700 just in fees, $3,000 just in fees to the lender alone on a loan amount of $162. That's basically twice, what I would say it's a fair deal. Okay. So be careful about that, guys. You want to stay sort of between that 1% of fees. All right. Now, one fee in this specific, loan estimate that I personally hate is the application fee. You should not be paying application fees. Absolutely not, ever, point blank. And let me tell you something, guys. Most lenders actually will not charge you an application fee, but if you go and shop around for lenders online, like maybe you go into Quicken Mortgage, Rocket Mortgage, Amerisave, or Loan Depot, or Better Mortgage, some of those lenders might actually charge you for an application fee because, they know that if you are shopping around for loans online, there is a really big possibility that you are going to shop around multiple times, because it's really simple to just shop around for a mortgage online, right? You have a slew of different lenders that can show you different rates, and see, the lenders know that you're just looking for interest rates. You're looking for who has the lowest rate. But obviously, hopefully, after you watching this video, you're not looking for the lowest rate anymore. So anyways, careful about that, guys. You should never pay for an application fee. You should not ever pay for something up front and just basically be tied down to one specific lender, okay? And I see the application fees, again, online lenders and also new construction lenders. So if you're going to a new construction site and they want you to just basically lock up the lot, and they're gonna give you all these closing cost discounts because you're using the in-house lender, and they're telling you to pay an application fee, just basically say, no, I don't want to pay an application fee. I'm going to use my own lender, or I have a lender that does not charge me application fee. And believe me, guys, you can always get that application fee dropped. I would say in about 99.9% of all cases. So that's basically my thing with application fees. Next thing that you guys are going to look at is going to be discount points. In this, you have to pay a close attention. I can't really stress this enough, guys. Because see, loan discount points are a way for lenders to buy down the interest rate. So basically, you qualify for this interest rate, okay? But, to get you into a lower rate that you don't qualify for, then you have to pay for it, okay? And see what, and that's the problem when you're just calling people, when you're just calling lenders, and you're asking who has the lowest interest rate, lenders will just basically throw 2% in discount points and just, give you a quote on some super low interest rate that you have to pay a ton of money for. That doesn't even make any sense because you won't see any savings, but it's just to basically psychologically get you to say, okay, well, I'm getting the best deal because I'm getting the lowest interest rate, right? So you gotta be careful about discount points. I'm gonna give you one tip that it's really going to, change the whole stratosphere when you're shopping around for a mortgage loan and when you're talking to any mortgage lender. And that is to ask, what is your par interest rate? PAR. Now, the par interest rate is basically the interest rate that you can qualify for based on your own qualifications, based on your credit scores, based on your house, based on your FICO, based on how much money down you're putting or how much equity you have in the house, based on what kind of program. This is the free interest rate. This is the rate that you qualify for. So you guys will see something like this. And by the way, when you ask that question, you're going to get every lender's respect because that lender will know that you're not a newbie. You're not a noob in this game. You know exactly what you're doing because par is really a term in the industry. But basically, say, for instance, in this example, this person, their par interest rate was something around 4%. But that 4%, the way the lender will see it is, as the price of the bond to get that 4% interest rate, that will be at 100. Now, in order to get this rate dropped to the 3.875, right, which is the rate that they're getting over here, they are paying 0.25% in discount point. Now, 0.25% times the loan amount is going to give you the amount of discount points. So take whatever loan amount, multiply it by the amount of discount points. That's going to give you the total of how much you're going to have to pay to get that interest rate. So then this guy, in order to get the 3.875%, the cost of the bond would be something like 99.75 because 99.75 plus 0.25 will be 100. So this is what the lender is seeing, and basically he is buying down the interest rate $400. It's not much, but that's to get you into that 3.875. Now, this is a good case. Some lenders might just say, you know what, he actually has no idea what he's doing. So we're just going to say we can do a 3.25% and we're going to charge him 2 points, because he qualifies for 4%, but he wants the lowest interest rate and he has no idea. So we're going to go ahead and just charge 2 points on the loan and get that low interest rate. Well, in this case, 2 points, that will be 2% times 162. That's $3,240 just on discount points to get from, say, I don't know, a 4% down to 3.25. Now, that's an example, but you're basically paying $3,200, which are going to be added in on top of your closing costs so that you can get a lower interest rate. You see, guys, that's what you have to ask what your par interest rate is, because you need to know what's the free interest rate that you're going to get. Okay. So once you have two different quotes from, two different lenders, you got two different loan estimates, you want to put them side by side. Everything else, guys, line B, C, and everything else in this loan estimate, honestly, it's going to be the same, almost the same everywhere you go. You don't shop around based on your title insurance. Don't shop around based on escrow payments at closing. That's going to be the same anywhere. You want to stay over here. This is exactly where you're going to focus when you're shopping around for your mortgage loan. All right. So once again, guys, I'm going to recap this real quick. Total origination charges, to me, fair, it would be somewhere between $795 to, 1% of your loan amount. All right. That would be fair. That's sort of where I would stay. If it's any more than that, you may want to consider, ask questions, ask why it's so high. Other things could be, maybe they're charging a few things. Maybe you're doing a different loan. I mean, if you're doing a crazy loan, like an FHA 203K or some like renovation loan, then it's fine. Those origination fees can be a little bit more expensive because it takes a lot more work to do, those kind of loans. But if it's just something like a standard conventional FHA, VA loan, USDA, then you shouldn't really be paying a lot on this, okay? Now, one last thing before I stop this video, it's gone a little bit longer than what I wanted to, but is some lenders may just say, you know what, we don't charge anything. There's no origination charges. We are free. We are free. Guess what, guys? In the United States of America, there ain't nothing free, okay? There ain't nothing free, because what these guys are doing typically is they're going to take your interest rate, say probably your par interest rate, you qualify at 4%, but you know what? They're not going to give you 4%. They're going to give you instead, say maybe 4.5. And 4.5 has what they call a premium on top, which basically is going to take that money. They're going to take that money, that interest rate, and basically wipe out the origination charges. So you're basically paying for origination. You're just doing it by increasing the interest rate. Now, that is not a horrible idea. That's, that comes into play a lot, if you're like refinancing and you're not going to stay in the property for a long time, or maybe you're buying a house, you don't have a lot of money, maybe you just have enough for your down payment and probably a little bit of foreclosing costs and need some help from the lender, then that's fine. Take on a higher interest rate. That way they can help you out with a lender credit. But that's honestly what they're doing, all right? They're just basically charging you a higher interest rate so that they can give you a credit, so that, your closing costs can be lower. And this is a very common strategy. So always be sure that you're asking what your par interest rate is when you're shopping around, when you're looking at 2, 3, 4, 5 different loan estimates. But that's it, guys. That's pretty much how you shop around for a mortgage. And this is how you can ensure that you're getting, a fair deal, I would say. Okay. Obviously, this could be something that you can use to literally get the best mortgage deal out there if you're just focusing on the numbers. But I would just go ahead and finish up this video with one thing, guys, and that is getting the best mortgage deal is not just about the numbers. Make sure that you look at the entire picture. You look at the numbers and you look at whoever you're dealing with, because in this business, guys, and depending on where you are in life and where you want to take your real estate adventures, I'd say, it's good to have a mortgage lender that's a professional, that's going to help you, guide you through the whole process, especially if this is your first time, whether you're buying a house or refinance, or it's something that you don't do a lot, or maybe you're thinking about investing in other properties. Having a mortgage lender that can walk you through and give you some really solid mortgage advice, not just now, but in the future, will be worth paying just a little bit more. That's it, guys. If you like the video, make sure that you like, subscribe to the channel, and literally takes you 0.001 seconds. So I'll definitely appreciate that. And of course, any questions, make sure that you put them down below in the comment box, and I'll be sure to get back with you as soon as possible. Thank you guys for watching. Let me know if you enjoyed the video, and I will see you guys until the next one. Goodbye for now.